Hello and welcome to Tax Matters. I'm Chamaka Ohauchi. How is your week going? We begin with breaking news as Mr. Muhammad Nami, Executive Chairman FRS and Chairman Joint Tax Board, has just stepped in as the President of the Commonwealth Association of Tax Administrators, CATA. Just on Friday, the 12th of November, Mr. Nami was the moderator at the 15th General Assembly of CATA, which was held virtually. Tax Matters will stay on the story and bring you blow-by-blow accounts as events unfold. In the meantime, from us as Tax Matters, it is big congratulations to Mr. Nami. Last episode, we brought you the first installment of our series on the PIA 2021. Our guides were three experts in the field, Mr. Ogunjemilusi, Mr. Olarewaju, and Mrs. Oshosami. We were able to cover some ground in that first installment. For example, our guests told us how happy they are to have a single piece of legislation covering the operation of the oil and gas industry in Nigeria, a first of its kind. We also got from them what they consider to be the major differences between the old legislations, the major one being the Petroleum Profits Tax Act, PPTA, as well as the major provision of this new chassis, PIA. The trio of Ogunjemilusi, Olarewaju, and Oshosami is still with us today. We'll be looking at the fiscal regime of the PIA, and if time permits, the potentials of the Act to attract foreign direct investment and, of course, local investments. Mr. Olarewaju, welcome to Tax Matters.
Thank you. It's my pleasure to be here.
What is the fiscal regime in the PIA?
The fiscal regime addressed the issues of allocation and then the tax payments, and it focused much more also on the contribution to the host community. The objective basically is to give an opportunity to an investor to come down to the country and also to increase government takes and the process to go about it, right from investment into the oil field down to the production of the crude oil, including the disposal of this crude oil, and then the filing of tax return and sharing of the profits, both by the government and the investors.
Talking about the fiscal regime, do oil companies still have to pay petroleum profits tax, which in the old act was at the rate of 85%?
Yeah, with the PIA, I would say some companies may still have to pay tax at 85%. I will explain. But the PIA in itself, as the rate in PIA is a lower tax rate of maximum of 60%, and you have minimum of 45%. Now, under the PIA, you are having to have two tax type. You are going to have hydrocarbon tax, and you are going to have corporate tax. Under the hydrocarbon tax, we have two types. The new entrants, those people that will take oil block after the signing of the law, the being into law, that is from that August you mentioned 16, they are going to pay tax, hydrocarbon tax at 15% and corporate tax at 30%, making 45%. While the existing oil blocks that convert, because they are going to have conversion, presently we use oil mining leases and oil prospecting licenses. They are going to convert. There's a program called conversion. If they are converting to PPL, that is petroleum prospecting license, and PML, petroleum mining licenses. When they convert, they are going to be automatically come onto this PIA. But if they don't convert, they will remain on the old law than on the PPTA. And while they remain, the law gives a room, an allowance of 18 months from the date of signing the law by the president for them to convert, or a longer period if they still have a license that has not expired. Their license period, the moment it expires, if your license period expires before that 18 months, you still have up to 18 months to convert. Or if your license period exceeds that 18 months, you can convert between that 18 months or until your license expires. So while you have yet to convert, you will be paying tax at 85%. So the PIA does not mean that we are not going to have a company paying 85%. It depends on when to convert. And the reason for this is to, number one, to guarantee the flow, not to disrupt the government flow of revenue, and also to allow the taxpayer the option to remain and to give them time to remain and decide. So, but if you don't convert, at the point of expiration of your license, if you don't convert, the license will not be renewed.
When you talk about the fiscal regime in the oil and gas sector, you talk about what an investor or an operator parts with in terms of money. So when we talk about the fiscal regime, we must start first of all with rent. So there's the payment of rent, there's the payment of royalty, bonuses, taxes, and levies. So all those 5 types of payments make up the fiscal regime. But I'll quickly make some clarification. So when I mentioned the establishment of 2 regulatory bodies. One of the roles of these regulatory bodies is to collect some of these fiscal instruments. So rent is paid directly to government on the acreage. That will be collected by the commission. So the upstream regulatory commission would be the one to collect the rent, as well as royalty payments as well. So the bonuses there are 2 kinds of bonuses. You have signature bonuses and you have production bonuses, typically in the fiscal regime of oil operations. That's also paid directly to payments, and that's usually, as the name suggests, tied to your production. Now, levies, of course, levies are somewhat administrative in nature. So oil operators pay a myriad of levies. So there are levies that they pay that go towards the lifting of crude and so on. But now narrowing down to what we're going to be talking about, because we're talking about tax matters, narrowing down the fiscal instruments to tax and royalty. Let me now speak to that in terms of what has changed in the PIA from what we had prior to now. So prior to now, we had the tax and the royalty. So tax is based on your profit and royalty is based on your production. So in the PIA, you have a new tax regime. You actually have the introduction of a new tax that has come to replace the petroleum profit tax that we had under the old regime. Under the old regime, for petroleum operations, for upstream petroleum operations, we had just the petroleum profit tax. And the oil operator was also liable to pay tertiary education tax. And then for downstream operators, they were liable to just company's income tax. And for anything in between, if your operations fell, if your midstream operations, because we didn't, under the old regime, we didn't have midstream operations defined by law, but those activities existed, most of which comprises gas utilization. Also under the old regime, we didn't have a clear tax regime for gas production, but we had for oil, we had for crude oil production. But the PIA now sets out a clear regime for oil production gas production, midstream gas operations, as well as downstream operations.
I go further about the fiscal regime. Fiscal regime also introduced what will be the accounting basis. And then they introduced the major one that we have been talking about while all of us are talking up to now. For the first time, we have the dual tax system in Nigeria. This is found under the fiscal regime, whereby all companies must file both the tax or the hydrocarbon tax. Before it used to be PPT, and nothing like company income tax, except they have for that company maybe gas before. But now it's a must. There are some costs that will not be allowed, something like salary, bank interest. You will need to treat this one under company income tax on actual year basis. And then why the only cost that will be allowed for the purpose of hydrocarbon tax will be the one that is related to the production of the crude. All costs spent on the feed. But all of that cost before that used to go in there has been moved to company income tax. Also, the fiscal regime come about that for each of the production, we used to have 3 kinds of allowances, depending on where you belong to: investment tax credit or investment tax allowance. Those are the one from prior to 1993 and then the one after 1993. That's when we used to have ITC and ITA. Then petroleum investment allowance come with the asset qualifying capital expenditure. But all those ones have been set aside, and then production allowance have been introduced based on the quantity of your crude oil produced per day and then per month and then per annum. This will form the basis under the fiscal regime. Under the fiscal regime, we look at the rate of tax has been changed. For the upstream sector, we used to have 85 at the upper level, and then we have 50 at the minimum level. The minimum level then used to be paid by deep offshore. The deep offshore that has about more than 200 nautical miles into the water, they are the one called deep offshore, above 200 nautical miles into the deep offshore. So then they used to pay 50% as their tax rate, but now it's 0%, which I say is a plus for government. We have the other entity, those for onshore and shallow water at 85, between 65.75 and then 85% before. But now it's just 15 to 30% that they're going to pay, which is good. But mind you, they have to pay company income tax at 30%. The existing list that want to maintain the way they are doing under the old PPT, they will be allowed to continue maybe for the maximum period of 20 years, and then they will go at 30%. But for anyone that agree to convert to the provision of PIA, immediately they will go at 15%. And then, so if you convert that, the existing 30 plus 30 you pay on that company income tax, that's 60, still not up to the 85 before. And then we consider 0 plus 30 equal 30 for deep offshore, which is not up to 50% before. And if you consider those that convert 15 plus 30, that's 45, still not up to 85 before.
I'm a very busy man. My business involves a lot of traveling, and I interface with lots and lots of people and organizations. Tax compliance used to be a big drag on my business. It was time consuming and very costly. But now, no more. Introducing the FIRS Tax Pro Max, the truly fully end-to-end tax administration solution for companies' income tax, value-added tax, petroleum profits tax, and all other tax types. For fast, efficient, and convenient end-to-end tax experience, log on to www.taxpromax.firs.gov.ng. Tax Promax has turned things around for me. It is fast, user-friendly, and cost-effective. FIRS, making tax administration as easy as ABC.
Coming to tax rates and the tax regimes that now apply under the PIA. For upstream operations, under the new licensing regime, you now have petroleum mining leases, which is the highest level of title that you can hold. You have petroleum exploration licenses, and then you also have petroleum prospecting licenses, typically holders of petroleum prospecting licenses do not pay tax because you're still prospecting for oil. So under the PIA, if you're a holder of a prospecting license, you're now liable to a hydrocarbon tax, which is a new tax that the PIA has introduced, of 15%, provided you're producing in a shallow water region or onshore. If you're a holder of a petroleum mining lease, your tax rate would now be 30%. Again, provided you're operating in a shallow water or onshore region. If you are operating in a deep offshore region, typically the deep offshore production operations in Nigeria are being done under production sharing contractual arrangements. So if you're operating in the deep shore region, you won't pay any hydrocarbon tax. So as a PSC contractor, you will pay just the company's income tax of 30%. Whereas holders of PMLs and PPLs operating onshore or in shallow water regions would, in addition to the hydrocarbon tax, pay a 30% company's income tax as well. So that then gives us an effective tax rate under the new regime of 60%. And if you factor in education tax, let's say 62% effective tax rate for PML holders, 47% effective tax rate for PPL holders, and 32% tax rate for production sharing contractors. For the royalty, the PIA also introduces a new royalty regime, and I'm not going to be reeling off royalty rates as I just did with the tax rates. That's a bit more complex. But the key thing is that the PIA now introduces a royalty regime that is not just based on production, but also on the price of crude. Which is why if the PIA had been passed 10 years ago, we would be in a much better place economically, because we would have made a lot more from the price of crude, which at the time was in the region of $100 and above in some cases. So, but back to where we are now, you now have a new royalty regime that is based on production and the price of crude oil. Now, when you look at the rates that the PIA has introduced, there's actually an effective increase in royalty rates than what we had in the previous regime. The royalty rates in the previous regime were actually relatively very low, and they were based only on production. So really, we weren't getting much from the previous royalty rate. So those are the two major fiscal instruments that has changed the game, really, in terms of the fiscal provisions of the petroleum, in petroleum operations today in Nigeria.
Another thing that is of importance that you can consolidate your costs, all your costs under the corporate tax. You consolidate your costs under the corporate tax, while at the hydrocarbon tax, you can only consolidate if you belong to either new entrant or converted. Because of this, because we have two different rates. Don't forget that we have two different rates. For new entrant, it's going to be at 15 for hydrocarbon, and for converted at 30%. So if a new company gets a new PML, petroleum or PPL, petroleum prospecting license, that petroleum prospecting license, because it is issued after the signing of this law, is going to be under the 15% regime. If you are having OML that you converted to PML, its old regime, you are going to be under 30%. Are you getting me? So, assuming a company that has been in operation now has a new oil block, which is now tagged PML, that PML is going to be able to tax at 15%, hydrocarbon tax. So it can consolidate the cost of 15% with the cost that incurs on the PML that is converted at 30%. So that's why you can, but for CETA you consolidate. Then another beauty of this are the PSC companies under the old law now, the Deep Offshore Land Basin Act, they don't file their returns. NNPC file returns on their behalf. They file returns through NNPC to us, but with the new law, they are going to file their returns directly, and we are going to assess them. And another thing that is very important here, under the PIA, anyone that is in deep offshores are the operations that are beyond 200 meters water depth. Anyone that's operating there now under the PIA will not pay hydrocarbon tax. It's going to be corporate tax alone. It's an incentive and makes it very easier and simple. There's a provision for this decommissioning and abandonment, which is a provision that we don't have. Now they are going to be funded. They're creating a fund for it. They create and you fund it, and whatever that is you put in that fund is going to be an unliable deduction. Then the host community, contribution to host community is going to be an unliable deduction in the hand of the people that the company that contributed it.
There you are, PIA 101 Part 2. We do hope that we are fulfilling our role as the home for information and education on taxation. We are not done yet with our focus on this all-important piece of legislation. There will be Part 3, but it will not immediately follow this one, but it will surely come. In the next few episodes, we will be showing you what tax authorities are doing to catch them young. At the secondary level,
as a speaker, if I am to personalize the topic, then it means what new ideas, principles, or logics would I suggest to make the Nigerian tax system more operative and productive? These are my suggestions in respect to the topic. Ladies and gentlemen, for a change of face for the Nigerian tax system and increase in its effectiveness and efficiency, there must be a stop to all forms of corruption in the system, one of which I'll be emphasizing on is the discretionary granting of exemptions. Many countries run into a huge loss of revenue through ill-designed exemptions like costly tax holidays and other irrelevant or inappropriate tax privileges, whereas common exemptions can reduce tax system's complexity while boosting revenues and also broadening the tax base.
Question number 4. Question number 4. The full meaning of TIN is dash. A, taxpayer insurance number. B, taxpayer identification number. C, trade insurance number. D, tax indemnity number. B. Correct. Question number 18. An example of indirect tax on spending expected to be borne by the final consumer of goods and services is known as A, company's income tax, B, commission tax, C, value-added tax, and D, capital gains tax. C. Is that a final answer? Correct.
at the tertiary level.
Now, the tax lens in Nigeria has been focused by the government on mainly the formal sector, thus ignoring the informal sector that accounts for about 80% of non-agricultural jobs in Nigeria, 65% of economic activity, 60% of urban jobs, 90% of new jobs, about 57.5% of the nation's GDP.
Tune in to Tax Matters on the same station, same day of the week, same time of the day, next week and every week. See you next week.